Good morning. I'm Benjamin Sullivan, and welcome to Market Monday for March 30th, 2026. When the stock market falls, where do investors go? For decades, the answer has been the same: Treasury bonds. It is one of the most reliable patterns in finance. Stocks fall, investors then seek safety, and bond prices rise. This week, we're going to look at why that pattern works, when it doesn't, and what it means for your portfolio. Let's start with the track record. During the dot-com crash, the S&P 500 fell 47% over 2.5 years. During that same stretch, Treasury bonds delivered strong double-digit returns. In 2008, the S&P 500 dropped 37%, while Treasury bonds returned over 20% that same year. In the fourth quarter of 2018, the S&P 500 fell nearly 20% from peak to trough, and Treasury yields dropped from above 3% to below 2.8%, meaning bond prices rose sharply. Each time stocks fell, Treasuries caught investors on the way down. Here is why it works. When the economy slows, two things happen. Growth expectations fall, making investors worry about deflation, not inflation. The Fed responds by cutting interest rates to support the economy. Lower rates increase demand and push bond prices up. This is called a flight to safety. Investors sell risky assets to buy treasuries, causing bond prices to rise and yields to fall. The worse the outlook gets, the more bonds tend to benefit. They serve as a hedge to stocks. Now let's look at when it stops working. In 2022, the S&P 500 fell 18%. Normally, bonds would have cushioned the blow. They didn't. The Bloomberg Aggregate Bond Index lost 13%. Stocks and bonds fell together for the first time in over 40 years. The cause was inflation. Prices were rising at the fastest pace in decades. The Fed could not cut rates to support growth. Instead, they raised rates aggressively. That pushed bond prices down at the same time stocks were falling. We saw the same dynamic during the tariff shock last April. When Liberation Day tariffs rattled markets, stocks sold off. Treasury yields fell for 2 days as expected. Then they reversed sharply. By the end of the week, yields were higher than before the announcement. The market was not worried about deflation. It was worried about inflation from tariffs, keeping the Fed on the sidelines. Now to this year. The S&P 500 had another week of sell-offs. The NASDAQ entered correction territory. In a normal environment, we would expect bond prices to rise. Instead, the 10-year U.S. Treasury yield climbed above 4.4%, an 8-month high. As stocks fell, so too did bonds. Oil is above $90 a barrel, and some are forecasting U.S. inflation to increase to 4.2%. The Fed held rates steady last week and signaled net cuts are on hold. Inflation is driving the bus, and when inflation is driving the bus, the traditional safety net doesn't work. When stocks and bonds correlate, we need to look outside of traditional financial instruments. Real assets like commodities, real estate, and precious metals tend to move independently. They can provide the balance that bonds cannot when inflation is the dominant force. These are the types of strategies that can improve diversification. It is a major reason we have been having more conversations lately about including alternatives alongside traditional stock and bond funds. And we will continue these conversations in the weeks ahead. If you are curious about how alternatives can fit into your plan, this is a conversation worth having now. Reach out to us and we will get you on the calendar. If you know someone who could benefit from this type of discussion, forward this video their way. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday. Join us again next Monday for more of the insights that matter to your money.